stop looking at the price chart for just 1 second, because we are witnessing a signal that has not flashed since the chaotic double top of 2021. Most retail traders are celebrating Bitcoin hitting $88,000 as a victory lap, but they are completely missing the structural fracture forming beneath the surface. There is a specific divergence between whale accumulation and retail sentiment that suggests we are entering a phase of maximum opportunity disguised as maximum risk. If you are holding positions right now or thinking about entering, you are walking through a minefield without a map. In the next 8 minutes, we are deconstructing the raw evidence that most retail traders are blind to, including the on-chain metrics that separate the tourists from the smart money. We are going to compare the current market structure against the 2021 top and project exactly how the 2025 and 2026 cycles will likely play out. Welcome to the engine room of the market. Let us look under the hood at what $88,000 actually represents in the grand scheme of historical cycles. To the uneducated eye, this looks like a parabolic breakout that is destined to go up in a straight line forever. But if you have been in this game as long as I have, you know that the market is designed to extract the maximum amount of capital from the maximum number of participants. We need to start by comparing the current landscape to November of 2021, when Bitcoin hit $69,000. Back then, the market was driven almost entirely by leverage and hysteria. The open interest on derivatives exchanges was at an all-time high, meaning people were borrowing massive amounts of money to bet on higher prices. That is a fragile structure because it only takes a small dip to trigger a cascade of liquidations. However, the data we are seeing today at $88,000 is screaming something entirely different. We are looking at a spot-driven rally rather than a leverage-driven rally. When we analyze the funding rates across major platforms like Binance and Bybit, they are remarkably neutral. In 2021, annualized funding rates were often hitting 50 or 60%, indicating extreme greed. Today, even at record highs, funding is sitting closer to 10 or 12%. Here's the kicker that changes the thesis for the next 2 years. We have to talk about the supply shock that is quietly playing out in the background while everyone is distracted by the price. Exchange reserves of Bitcoin are at a multi-year low. In 2021, there were roughly 2.7 million Bitcoins sitting on exchanges ready to be sold. Today, that number has dropped below 2 million. That is 700,000 Bitcoin that have been removed from the liquid supply and moved into cold storage or institutional custody. This creates a powder keg dynamic, where even a small increase in demand forces the price up significantly because there is simply no liquidity on the sell side. Before we dive deeper into the whale wallet movements that are confirming this trend, if this level of data helps your strategy, consider supporting the analysis by subscribing to our inner circle. We focus purely on the signal and ignore the noise, so you can make decisions based on math rather than emotion. Now, let us address the elephant in the room, which is the institutional wall of money. The introduction of the spot Bitcoin exchange traded funds has fundamentally broken the 4-year cycle models that we have relied on for a decade. In previous cycles, capital flowed from Bitcoin to Ethereum and then down to smaller altcoins in a predictable waterfall. But the corporate treasuries and pension funds buying the exchange-traded funds are not interested in rotating their profits into speculative small-cap tokens. They are sticky capital. When BlackRock or Fidelity clients buy, they are generally holding for a 5 to 10-year time horizon. This brings us to the critical comparison of the 2025 cycle versus the 2026 bear market projection. Historically, Bitcoin cycles are defined by liquidity injections from central banks. We track the global M2 money supply, which measures the amount of cash circulating in the global economy. In 2021, the money printer was turned off, and the Federal Reserve began tightening, which crushed the market. Right now, as we head into 2025, the global M2 supply is expanding again. This suggests that we are in the early to middle innings of the cycle, not the end. However, this is where the insider strategy gets complicated. We have to discuss the concept of a left-translated versus a right-translated cycle. A left-translated cycle means the market peaks early and then bleeds out for a long time. A right-translated cycle means the market grinds up slowly and peaks late in the 4-year window. The data currently suggests we are moving toward a right-translated cycle, which would place the true cycle top somewhere in late 2025. But there is a massive trap waiting for those who think history will repeat perfectly. The volatility is dampening. In previous cycles, we would see 30 or 40% corrections routinely on the way up. With the institutions now controlling a significant portion of the float, those dips are being bought up aggressively. preventing the deep flushes we are used to. This sounds good, but it actually makes trading much harder because you do not get those obvious entry points. You are forced to buy strength, which is psychologically difficult for most retail investors. I want to highlight a specific metric called the MVRVZ score. This metric compares the market value of Bitcoin to its realized value, or the average price at which every Bitcoin last moved. In 2021, this score peaked around a value of 7. Right now, even at $88,000, the Z-score is hovering around 3.5. This implies that despite the all-time highs, the market is not yet overheated relative to the cost basis of the network. We have room to run, but that room is going to be volatile in a way we have not seen before. This leads us to the grim reality of 2026. If you are planning to hold forever, you need to understand the risk of a secular shift in the macro economy. By 2026, the initial wave of institutional adoption will likely have plateaued. The supply shock from the halving will have been fully priced in. Historically, the year after the bull market peak is a brutal winter, where assets lose 70 to 80% of their value. However, the 2026 cycle might look different. Instead of a crash, we might see a long and painful period of sideways stagnation. If Bitcoin establishes itself as a true reserve asset, comparable to gold, volatility will continue to decrease. A crash of 80% becomes less likely, but a slow bleed or a flat line for 2 years can be just as destructive to your portfolio if you are paying fees on leverage or if you are overexposed to altcoins that bleed against Bitcoin. Before we get to the final price targets and the exit strategy, if you are finding value in this deep dive, make sure you are notified for our next briefing, because the situation on-chain changes daily. Let us talk about the exit strategy, because buying is easy, but selling is the hardest thing you will ever do. The psychological barrier of $100,000 is going to be a war zone. Retail investors love round numbers. We expect a massive sell wall at $100,000 as early investors take profit. But the on-chain data suggests the whales are positioning for prices well beyond that. They are looking at the market cap of gold, which is roughly $14 trillion. Bitcoin at $88,000 is sitting around a $1.7 trillion market cap. Even if Bitcoin only captures half of gold's market share, we are looking at a price per coin of over $300,000 in the long term. But that is the long term. For this cycle ending in 2025, my models are pointing to a blow-off top that coincides with a peak in global liquidity. The danger zone begins when the short-term holder supply starts to spike. Currently, short-term holders, or people who have held for less than 155 days, own a very small percentage of the supply. This is bullish. When you see that metric flip and short-term holders own more than 50% of the realized cap, that is your signal to get out. That is exactly what happened in April of 2021 and November of 2021. The smart money handed their bags to the retail tourists, and the metric flipped. We are watching this specific data point like a hawk. So here's the game plan for the next 12 to 18 months. Do not get shaken out by leverage flushes. Understand that $88,000 is technically high, but fundamentally sound, based on funding rates and exchange reserves. Watch the global M2 money supply as your primary macro indicator. And most importantly, prepare for the liquidity shift in late 2025. The 2026 bear market will not take prisoners, and the strategies that worked in 2022 will likely fail because the participants have changed. We are no longer fighting against other retail traders. We are trading against algorithms and institutional desks with endless pockets. To survive this, you have to think like them. You have to be patient when others are panicking, and you have to be fearful when your neighbor starts asking you how to buy Bitcoin. We remain in a high conviction uptrend, but the easy money has already been made. Now is the time for precision and discipline. Stay glued to the data and do not let the hype cycle dictate your portfolio allocation. I will see you in the next briefing. Disclaimer: the content provided in this video is for informational and educational purposes only and does not constitute financial advice. Crypto assets are highly volatile, and you should conduct your own research or consult a certified financial planner before making any investment decisions.